I do see quite a few familiar faces in the room, but for those of you who don't know me, I'll take a few minutes and just introduce myself. My name is Lauren Epperly. I am pretty much a lifelong resident of either Berkeley or Jefferson County. I moved from Loudon when I was in kindergarten, grew up in Jefferson County, bought my first house in Martinsburg, spent a few years here, but have since moved back to Charlestown. I am married to my high school sweetheart, Todd. We've been together since we were 15, so I don't really remember life before him at this point. We have two beautiful girls, Chandler and Lillian, who are 7 and 4. Professionally, prior to becoming a financial advisor with Equitable early this year, I spent 15 years in banking, and some of you may recognize me in that capacity. The most recent 8.5 years were with BB&T, which is of course now Truist. I functioned in the branch leader role. I really enjoyed that because I enjoy coaching people, developing people. I also enjoyed the lending capacity that I filled, helping people kind of think outside the box sometimes to meet their needs. But something, as I think many of us found, shifted inside of me during COVID. I had previously been pursuing a regional leadership position within the bank, I realized that I was, when we were locked down, I was really enjoying more time at home with my family. My girls are growing up really quickly. I'm involved in everything in their lives, coaching soccer, coaching basketball, involved at our church. So I didn't want to miss any of that. I didn't want to travel half the state, even if it wasn't overnight, and getting home late, leaving early. So it really caused me to reflect on what I wanted to do. I had always been interested in the investment and financial advising world, and had always said within BB&T, to my leaders that if something changed and I didn't pursue regional leadership, it would be this career path that I wanted to follow. So I did some soul searching, thinking about whether my career should continue within banking, whether I should look at outside firms, but ultimately kind of what won out is the fact that my brother-in-law, some of you may be familiar with him, Nick Ira, he has been a financial advisor with Equitable since right out of college. So 15 plus years. He has been my advisor for over 10, so I had the personal experience with Equitable. So it was exciting to kind of venture out, take a bit of a leap of faith, have the opportunity to be mentored by family. And I'm really enjoying the fact that really my interactions with clients are much less transactional than they were at the bank. And I'm sure all of you have felt that. You've had the very transactional clients that maybe you never speak to again. But what we really thrive on, right, is the long-term relationships. The people that come back to you, the next time they sell a house, the next time they buy a house, those who refer their friends, their family members. And, what we do allows me to build those long-term relationships. I kind of half-jokingly tell people I want to be listed on their favorites on their phone. I want to be in the top 10 people that they call when there's a big life change, such as retirement or a wedding or, the more unfortunate things such as a death. So I really am enjoying the time that I can spend one-on-one with people, not necessarily transaction after transaction, and the ability to build long-term relationships. And the other part, was the time, the flexibility, as I'm sure many of you enjoy, to maybe leave the office and go to a meeting at my daughter's school at St. Joe's and then go back to the office, really work around what was important, because I am involved on so many levels that, I didn't want to give any of those things up. I should also share, why I joined the Board of Realtors as an affiliate as well. In my 15 years in banking, I spent a lot of time with small business owners, and really, realtors are essentially small business owners, right? I mean, you're working for yourselves, and what I found is that so often, small business owners across the board just pour themselves back into their business. They are so devoted to their clients, to growing their business, that they often neglect the personal finance piece of things. So, you know, I see a knowing smile. So, you know, I really want to serve you guys and provide education where you need it. And I can be persistent and pleasantly pushy, as Nick tells me, you know, because I know you're pulled in a million different directions. And if you need that accountability partner, I can certainly fill those shoes. And I was talking to Shannon at the fair Friday night. I just have a ton of respect for your profession. For one, you know, the hustle that you guys constantly display. But beyond that, as I was telling Shannon, I really appreciate the camaraderie and support that you all offer each other. And I wish that that existed in so many other professions. So my hat's off to you guys. You are definitely doing something right, and you have my utmost admiration. Okay, so required disclosures, you'll see a large pack in your folder as well. In essence, the disclaimer is I am not an attorney, I'm not a CPA, though part of what we're going to talk about is tax specific. I would always defer to your CPA and your tax advisors. So just a little bit of background about Equitable, because I know that a lot of people have not heard of us. We have been around over 160 years. We have over 2.8 million clients, and there's over 4,300 advisors throughout the country. Nick and I, at the moment, are the only ones in this area, but we're hoping to grow that and create an office with a nice, you know, family feel, a couple junior advisors who can ultimately become our succession plan, kind of give me back some of that coaching, mentoring ability that I'm so passionate about. So, you know, hopefully you'll see more of us in the future. The longevity and stability, though, of Equitable was certainly important to me, though, in thinking about, okay, I'm taking this leap of faith. It's great to be mentored locally by Nick, but, you know, beyond that, I need to feel supported. And, you know, our network of other advisors, CPAs, CFPs, you know, they really lend a ton of support to a new advisor such as myself. And I'm sure many of you recognize our office building. We've probably closed at Patriot's office. I'm down on the first floor there, so right here in Martinsburg. So what we're going to talk about today, first is a financial concept called 234. So all things finance, particularly in the investment realm, can feel especially overwhelming. Even after spending 6 months last year going through all the extensive licensing, going through, you know, continuous education now, it still feels overwhelming to me, let alone a person, you know, not as fully engulfed in this profession. So this is just a high-level concept that can really be applied to a lot of different things in your financial life. You'll see that it ultimately includes 2 pyramids, 3 buckets, and 4 boxes. And all of these things are intended to demystify things like financial analysis, portfolio allocation, and product choices. So before I jump in to the 234 approach, just by show of hands, who has questions about their financial future? Me too, right? Nobody's immune from that. What are some of those questions? Retirement, okay. Any other big ones?
Do I have enough money to get me through?
Okay.
Investment.
Okay.
Life insurance, do I have enough life insurance
Absolutely.
as self-employed?
So these are all things that, this concept can ultimately help shed some light on. So the two pyramids in detail, I won't read the slide to you guys because you can certainly read it up there, but what I do want to use as an example is my own personal experience. So I had a degree in finance from Shepherd. I was well established in my banking career, so certainly a higher level of financial knowledge than the average person. But what I found about 10 years ago when I became Nick's client is that I was taking what you see on the bottom called the common approach. This is what I experienced with probably 95% of my clients within the banking world. People started by accumulating some financial products. In my case, I had a previous employer 401k. I started my 401k at BB&T. I purchased a life insurance policy for my Allstate agent when I purchased my house. I was trying to do things right, but that's what made up my portfolio. And ultimately, I wish I could draw a big red X through the strategy triangle here because I didn't have one. I didn't know what all of those things were ultimately going to accomplish. I knew I wanted to fund my own retirement, didn't want to, I wanted to live a comfortable way of life in retirement, but I didn't know when that was going to be, if I was contributing enough. So what we try to do is flip that on its head and use what's called the professional approach, where we start at the bottom. We start with strategy. In my case, when I first came to Nick as a client, I came with the intention of rolling over a 401k from that previous employer. I was kind of taken aback when he started asking me questions, such as, when do you want to retire? How much income in today's dollars do you want to live on in retirement? I looked at him like he had two heads because I was 25-ish years old at the time. Like, I have no idea. I don't want to work forever, I know that. But the process forced me to define some of those goals. We've also, along the way, talked about difficult things such as, what I wanted life insurance to accomplish if my husband or I pass away. That has changed dramatically over the years. Now, I said my girls are 7 and 4. We would need to replace our income for several years for them to maintain their way of life, to stay at the babysitter we love, to stay at St. Joe's, continue all the sports and horseback riding and all of that stuff. So, we had those difficult conversations that admittedly kind of made me really, really uncomfortable. We've also talked through things such as, in terms of education funding, what I wanted to provide. When they were born, I knew I wanted to start at 529, but I didn't really think about, okay, do I want to fully fund their education? Do I want them to have some investment in their future? So we really start with those strategy things, then look at an existing portfolio, and if there are gaps between the two, make any product recommendations. So this professional approach is certainly something that can be implemented either independently with another advisor. It's not Equitable specific by any means. Any questions about that before I jump into the 3 buckets? Okay. So the 3 buckets are really just breaking your financial goals down into 3 categories, either short, intermediate, or long-term goals. You'll see definitions there of each of those time frames. And really, what I would impress upon you there is that most people don't effectively classify their goals. And what that ultimately leads to is they don't choose the most efficient financial instrument, and they don't properly understand the risks with the instruments that they choose. So, once you identify and place your goals within those buckets, another thing is that you need to think about things such as liquidity, product charges, investment flexibility, and taxation, which we're going to come back to it kind of in a lot more detail. Those things all become incredibly important. And then finally, in the 2, 3, 4 concept, we come to 4 boxes. So This really is just reflective of how taxation affects the various types of investments. And that can be both while you're saving and also when you're in a distribution stage. So just to look at some examples there. And before I jump into the examples, actually, I will point out that the greatest arbiter of long-term wealth is the effective management of taxation. And that can be when, where, and how you're taxed. That has a huge impact on whether or not goals are achievable or not. So box 1 here, you'll see investments really with no tax advantages. This is not somewhere where you want your money unless it's like a 3 to 6 months savings, maybe a little bit more in a variable income, type profession, or something that you're saving for a major purchase in the near future. So there, think of savings accounts as a good example there. They're after-tax contributions, they're taxable during accumulation, and the interest is taxable as you receive it. So again, no real tax advantages. 2 are those things that do have some tax advantage. So they are after-tax contributions, non-taxable during accumulation, but taxable at distribution. So the example that I'll give you there is, think of, and I just had this scenario with a client, someone who had not saved a ton for retirement, inherited some real estate, sold that, and ultimately put those funds into a non-qualified or non-retirement annuity. That would be an example of box 2. So they pay taxes on that transaction, they're after-tax funds going into the annuity. During accumulation, those are tax deferred, but when they distribute them, they're taxable. Does that make sense? Box 3 is kind of 3 and 4 is where we're going to spend more of our time today. So box 3 has even more tax advantages. Those are pre-tax contributions, non-taxable during accumulation, but taxable at distribution. So there, think of a traditional IRA, 401k, 457, things like that. This is generally the box where you really want to max out box 3 before moving to box 4. And then box 4 are potentially even more tax advantaged with after-tax contributions, non-taxable during accumulation, but also non-taxable at distribution. So anyone want to venture to guess what the most common example in that space is?
529.
Could be. I was going to say Roth IRA, but 529s are certainly, very common as well. Roth IRAs are something that I jokingly call the 8th wonder of the world because of the tax efficiencies. So any questions about kind of the different categories of assets? And really there, I'll just say that tax diversification, we're often looking for, tax efficiencies now while working, but tax diversification in retirement is honestly just as important, because I think regardless of political affiliation, we can all agree that tax brackets probably have to increase from here, with the government spending that's going on, the fact that we are at historical lows. So, we do need to be cognizant of the fact that many of us will likely be in higher tax brackets in retirement, even if we are earning a lower wage base. So this is where I wanted to spend most of the time today. Factors to consider when choosing a retirement plan. Because again, I know that self-employed individuals, commissioned individuals often neglect their long-term retirement savings because they don't know where to start. So
a couple things to consider when choosing a retirement plan. You're going to want to think about whether or not the plan allows pre-tax employee contributions, fixed or flexible contributions. That's especially important in an industry where there's some variability of income. That's not necessarily consistent. You're going to want to think about the amount that ultimately you want to contribute, the number of employees eligible to participate, as well as their age and income, and the expense and complexity of administering a retirement plan. So before I jump in, does anyone, raise your hand if you have employees, even like an administrative assistant or, okay. So we'll definitely talk about both scenarios, the self-employed, no employee scenario, but then also having a couple employees. So some advantages of having a retirement plan, any of the kinds that we're going to talk about, are that they offer tax deductibility, they can offer tax-deferred accumulation, protection from claims of many creditors, that's something often overlooked. And then distributions, ultimately, should you change professions, end up leaving real estate, for example, going to work somewhere else, could be rolled over to another plan, an IRA. Some disadvantages, though, quite honestly, to any type of retirement plan are often the cost to fund and administer the plan. We especially see that when we get into the 401k space with multiple employees. Navigating the eligibility requirements, because you need to be sure that you are, especially in the scenario, an employee or two, contributing as you should for everyone across the board. Disclosure requirements and annual testing. So, that doesn't exist on some of the more simplistic scenarios we're going to talk about, but as you get up there in complexity, that can be a huge deal. So let's talk about the available options. We'll talk about all of these in some detail, spending the most time just because of survey of the audience in the SIMPLE IRA, the SEP IRA, and the solo 401k space. But we'll also touch briefly on traditional 401ks and profit sharing. So let's start with the SIMPLE IRA. Not necessarily because it's the simplest, but some highlights of it are that it's a really good option for self-employed individuals or small businesses with a few employees, actually up to 100. The way this works is each participant in the plan is set up with their own individual IRA. And actually that can be done through different providers. So, in a scenario, maybe there's the business owner, 3 employees, one of them is adamant about setting up that SIMPLE with their existing advisor. There is some flexibility there. This requires very limited administration, so it's less costly than administering a 401k, and it eliminates some of the complex reporting required of a 401k. So let's talk about what SIMPLEs offer in terms of contributions. So eligible employees can defer up to $14,000. So that's one benefit right there, because does anybody know what the IRA contribution limit is for 2022?
6,000.
Yes, 6,000 with just a regular traditional or Roth IRA. 7 if you're over 50 and eligible for the catch-up contributions. So with the SIMPLE, that's more than doubled essentially, with the 14,000 contribution limit and an additional 3,000 for catch-up contributions. One of the kind of specifics of a SIMPLE that set it apart is the fact that employer contribution is required at a defined level. So who here has had a 401k before? Maybe in a previous life. You normally hear, well, they match up to 6% of your salary, then maybe 50% of the next 3%, or, different thresholds there. With a simple, that contribution limit is essentially defined. So the employer has the option of a 100% match up to 3%, nothing beyond that, or, and that would be for all of the employees they have who are contributing. Or they could do a 2% non-elective contribution for all employees. Meaning, if I have 5 employees, only one's participating in the simple, if I choose the 2% option, I'm contributing 2% for all of them, even if they are not contributing. So different, pros and cons to each. One of the drawbacks of this particular type of plan, if you do have employees, is it offers 100% immediate vesting. That's great for the employee, but that can cause issues in terms of employee retention. Because ultimately, a lot of times employees will stay somewhere, just because they want to be fully vested in their contributions. So again, just kind of elaborating on that immediate versus delayed vesting. The immediate vesting just means that they have 100% ownership, not only of what they contribute, but also what you contribute. And even if they're there 6 months, you contribute a certain amount, they leave, they can take that all with them. With other plans that offer delayed vesting, there are different options where you can do that either on a graded or cliff manner. So just a few requirements with the simple. It is only available with 100 or fewer employees, so that would be an option for everyone in here. Employees are eligible if they earn $5,000 in the previous 2 years, and they're expected to again in the current year. Employer contributions are mandatory, again, either that 3% for those who are participating or the 2% across the board. 100% immediate vesting, limited administration. Another important point, say that you start with a simple and ultimately want to switch to a 401k, which we have had a few realtors that we work with decide to do that. A simple cannot be offered in the same year as another plan. So that needs to be a thought out thing. But there's no annual IRS reporting. So again, keeping those administrative costs down. So things to consider when thinking about this type of plan is just ultimately what your goal is, how important it is to retain employees, and that loans are not permitted. So any questions about the simple before we move on to the SEP? Does anyone have experience with the simple specifically? Okay. Does anyone have experience with the SEPs specifically? That tends to be the more common one. It is ideal for businesses of all sizes, including self-employed individuals, whether that's full-time, part-time. So this is a viable option, for someone who maybe is part-time in real estate, for example, has a full-time job. They're participating within their company 401k, but also want to save outside of that. This, however, is funded solely by the employer. So that can be a drawback if you have employees, but for most of you, that's not the case. Even higher contribution limits than the simple. So employers can contribute and deduct the lesser of 25% of an employee's contribution, or $61,000. That can be incredibly impactful, lessening the tax burden in that business. Some other things to consider, and this is why this is pretty popular within the real estate profession. Contributions are discretionary and can be skipped. So oftentimes, we'll have realtor clients who, they kind of wait until they're filing their taxes to say, okay, where am I at for the year? Do I want to contribute to my SEP? Do I want to just skip this year altogether? So, I mean, these are probably most often contributions right at tax time. As a matter of fact, I had one lady call on the tax filing deadline this year, and fortunately I happened to be available to set up her SEP, but I was like, oh my goodness, we can't do this again. Just like the SIMPLE, an IRA is established for each individual employee. And again, all employees must be included in the plan. So a little bit different than a SIMPLE where, because the employee isn't contributing, they don't have that option. The employer, if they choose to set up a SEP, has to contribute for all of their employees at the same level. So let's say you have one employee and you decide, I want to set up a SEP so I can contribute 25% of my salary. You also have to contribute 25% for your employee. So that's why these are a little less common in the employee space. But pretty simplistic, no government reporting. Again, employees are 100% vested immediately, so that can be a concern when it comes to employee retention. Part-timers can be eligible. We talked about employees can't contribute, and just like SIMPLE's, loans aren't permitted. Questions about SEPs before we move into solo Ks? Has anyone heard of a solo K or an individually owned 401k? This is a largely underutilized tool. So this is something that could be especially beneficial in many of your situations, I'm sure. So they are designed exclusively for owner-only coverage. And that can be like an LLC, a corporation, but it can also be a sole proprietor. So don't hear, that and think that I'm just talking about corporations. They can be extended to family members, so maybe you have a child, a teenager who's working with you, helping in the summer, you could contribute on their behalf. It just cannot extend to true statutory employees. Does that make sense? It can also work for people who have part-time or seasonal employees beyond family members. It also has the availability of Roth contributions. So anyone who's contributed to a 401k previously, you may have had the option of designating your contributions as traditional or Roth dollars. The solo K does allow that. It has some of the features of a traditional 401k, such as hardship withdrawals, which can be important. And the employer contributions can be deducted in an amount up to 25% of total contributions. So that, again, can be especially impactful. So they offer all the benefits of traditional business retirements, but they're going to offer higher funding limits than the SEP or the SIMPLE. They're going to offer flexibility, access to tax-free loans, just like a corporate traditional 401k, up to $50,000 or 50% of your balance, whichever is less. There are flexible distribution options, and though potentially a little bit more costly than a SIMPLE or a SEP, still very low cost, low maintenance in the grand scheme of things. People hear 401ks and think that those can be very costly to administer, and they can. That's why I say this is one of those underutilized tools for sure. There are some different funding options. Most common would be, in your line of work anyway, is discretionary profit sharing, up to 25% of compensation because of the variable income nature. But it could also be set up as salary deferral with the same contribution limits as a traditional 401k. That should say 2022 of $20,500. The
the top side limit is $61,000 in contributions from both the employer and the employee. So really stretches that contribution limit, which, real estate agents in particular are earning more than they have in a long time. Hopefully that continues over the next couple of years. So, that can be incredibly important. Also, larger catch-up contributions, $6,500 for this year, and ultimately, the amount of your compensation to be considered is $305,000.
Employee salary deferrals are permitted. So just like, me contributing to my Equitable 401k where I contribute from my paycheck and then, Equitable also matches. Same thing even with the solo 401k. Again, the high contribution limits, limited cost, pretty simple to administer, but adding the flexibility of loans and hardships withdrawals. But again, just the big caution there is not available to businesses with common law employees. That's not to say you couldn't eventually add those and then just change plan types to a traditional 401k. But greater administrative requirements and costs than a SEP. I won't spend a ton of time here. This is the traditional 401k space. The two of you who said if you have employees, how many do you have? 12. Okay. So that 12 may break into the 401k space. With one employee, it's not going to be cost effective. So that's kind of why I said I won't spend a ton of time here. But eligible employees can contribute up to the lesser of 100% of their compensation or $20,500. Again, that $6,500 catch-up contribution. 401ks are much more costly to administer, however, because then there are different testing such as actual deferral percentage, and some additional testing that can be pretty expensive and complicated. A couple things to think about in this space. Employers can match based on a variety of formulas. So much, you can really set up a 401k any way that you want. When we set one up for someone, there's a laundry list of questions we ask in terms of vesting and deferral percentages, matches, all of those things. But again, the same $61,000 contribution for 2022. We talked about most of this. Again, additional IRS reporting through Form 5500 and some related schedules. But, especially beneficial for larger corporations who really want to retain employees, minimize turnover. And then profit sharing is really more of a flexible contribution. It's for businesses of any sizes, including individuals with self-employed income. Similar contribution limits to the 401k, but some things to consider. It is discretionary, permits some Social Security integration. You do have some flexibility in choosing a vesting schedule. So similar to the 401k, really. So some things to think about when ultimately choosing the plan type for your business. So evaluate the options, decide which of those factors are most important. I know that all of those factors probably still feel very overwhelming. That's where a financial professional comes in and helping you think through all of those implications and ultimately selecting the most appropriate plan for your business. The invitation that Gina sent out did reference some other considerations for self-employed individuals that I'll touch on here. And we can certainly dive into any of these either individually or as a group in more detail. But, In a self-employed scenario, you don't have the benefit of employer-sponsored disability insurance or employer-sponsored life insurance, as Shannon mentioned. Maybe you are bringing on employees and you want to offer them some type of benefits. Those are all additional things that we can offer, and the two biggest ones in your line of work, honestly, are the disability insurance and the life insurance. People tend to gravitate more toward life insurance because that seems like a bigger event in our minds, an event that is unavoidable, but disability claims are also incredibly prevalent. So even for someone who works for a corporation, has the average 60 to 70% income replacement policy, we find too often that even that is not enough. I'm working with a couple now who's finding that out very quickly because the husband became disabled at a pretty young age, at about 45, and they're making ends meet on his disability coverage, but what they're finding is they don't have the ability for him to continue to contribute to retirement. In particular, that 60 to 70% that he receives is still taxable, so there's another part. I see a knowing nod. It's the space that if you have known someone to go through it, you realize how important it is. It is also important to find a financial professional who's going to coordinate with your other advisors, such as CPAs and attorneys. I can't impress the importance of that enough. And another thing, to think about is the planning services necessary in starting a business. If, say you do bring on a team and you ultimately grow this business, there's planning to be done in the startup stage, but also in the business succession stage as well. So any questions about any of those things? Anything that we talked about? Yes, ma'am.
Do you have to form an LLC before you can do this, to have your own business? No, you're just an independent
Yes.
contractor. Okay.
Yeah. Good question. Other questions? Does that feel completely overwhelming?
For me, I have a 401k that's been sitting out there for 10 plus years. And I
It's a
haven't
common
really-
occurrence.
And it's making money. That's why I haven't done anything with it. And exactly, do I put it in a Roth IRA or what do I exactly do with it?
Is it a Roth 401k or is it a traditional?
It's a traditional.
I assume so based on how
Yeah.
long you said it's been out there. To answer your question very directly, if you put it into a Roth IRA, it could be converted to a Roth, but that's going to increase taxable income now. But essentially, when you leave an employer and you have a 401k, there are 4 things you can do with it. You can leave it, often the path of least resistance. You can cash it out,
Which I don't want to do.
you don't want to do. I mean, there are emergencies that necessitate that for people, for sure. But for the most part, not advisable. You can roll it over to a new employer plan, if you ended up working somewhere that had a 401k, or you can roll it over to an IRA. Either traditional or Roth, depending on whether you wanted to convert any of it and create taxable income immediately.
So is a regular IRA better than a Roth?
It depends.
Okay.
Blanket answer, there are definite additional benefits to a Roth. Does that apply to everyone? Absolutely not. That's very individual specific. But I think the big thing in, do you leave it in the 401k? Do you roll it over to an IRA? The biggest considerations in the 401k, you may still have loan capability. Sometimes you do, sometimes you don't as a prior employee, but that's the biggest thing. the benefit of the IRA is a lot more flexibility in terms of investment choices and products. Because really, an IRA is, think of it as a jacket. Let's say that you and I are each financial vehicles. You know, you're a bank CD. I am a brokerage account holding stocks and mutual funds. Either of us could put on this jacket or this wrapper and be considered an IRA. So there's a ton of flexibility in what you ultimately do with IRAs. Does that make sense?
Mm-hmm.
Okay.
Because I have, you know, like, I have 2 CDs too that expire at the end of this year. So I was wondering, I want to roll those in, because they're not making any money. Rolling those into an IRA too. Because those were in a 401k, but they were less than $5,000.
Okay.
So I had to roll those into something really quick.
So
I
are
didn't
they
know
in
what
an
to do with
IRA CD then?
Yeah.
Okay.
Mhm.
Yeah, so that, I mean, that would be a lot of flexibility too. If they were just CD funds.
No, they're in just CD funds right now. But I want to
Well,
roll them.
non-IRA CD funds. I was
Yes.
gonna say, just be very cognizant of the contribution limits. That can be,
Because I want to roll them into something without having to get, you know, pay penalties or whatever it is.
yeah. And, you know, generally, the more you have invested, the greater opportunities are available to you. So, you know, you may have had limited availability, you know, if they were smaller CDs.
Mm-hmm.
But if you consider consolidating those in 401k, that could greatly.
That's what I want to do.
possibilities.
Mhm.
So, yeah, you're thinking down the right path for sure.
Okay.
So, and I'm not trying to be funny, but on TikTok,
Oh,
they do that, you know, 401k is not for retirement, you should do like blah, blah, blah. So what's your opinion? It's like, you could, and they put the Tony guy